We are in the midst of the biggest financial opportunity of our lifetimes. Learning basic technical analysis can help you make sure that you do not miss out on this opportunity. If you want to learn TA and become a profitable trader in this market, we have built the ultimate training course to give you the skills to do just that. No experience or prior knowledge is required. Our 6-chapter course is designed to teach brand new traders the ins and outs of how to become profitable and take advantage of the biggest financial opportunity of our lifetimes. 6 chapters, 44 videos. You can get through these at your own pace. And if you watched everyone back to back, you could be done in under 1 day. Each chapter has its own PDF text, trading journal, templates, calculators, and a ton more other useful trading tools.
But wait, there's more.
For the next 2 weeks, we're offering the course for 50% off. And with your purchase of the course, you get 3 months in the Telegram group that gives you access to our trade setups for Bitcoin, Ethereum, and a number of other altcoins. Your membership gives you access to all of the exclusive trading resources on our website. This includes trading tools, cheat sheets, textbooks, discounted offers, indicators, fillable PDFs, and a ton more. You also get access to members only live streams where we answer your TA questions on Bitcoin, Ethereum, and a number of other altcoins. So get on over to the website, 3candlecollective.com, and sign up right now.
Self-destruct sequence activated. 3, 2, 1.
Is this your homework, Larry?
Ask him about the car, man.
Is this yours, Larry? Is this your homework, Larry?
Is that your car out front?
Is this your homework, Larry?
We know it's his fucking homework. Where's the fucking money, you little brat?
All right, how's everybody doing? Moving right along here. So in an effort to go ahead and get you up to speed to participate in this market, I'm going to start this whole chapter off with a small lesson on how to read the charts in the trading groups that you are a part of. So whether you're taking trade ideas from the 3 Candle Collective group or any other trading group that you might be involved in, understanding how to read these charts, where to place your limit buy orders, how to enter into these potential trades, how to understand where to take profit can be pretty difficult, especially for the brand new trader. So what I want to do here and what the goal is to familiarize you with these chart setups, how these chart setups work, how to enter into them, and how to take advantage of, some expert technical analysis that you will find in really any Telegram group that has a reputable reputation and really has a reputation for success. So if you are in my group, if you are in the Crypto Revolution group, if you're in the Bull, if you're in really any group that really does well at trading, understanding how to interpret these charts is really important and crucial to your success. So it's highly recommended that before you start trading or buying or exchanging any cryptocurrency, 1, always consult with the licensed financial advisor, and 2, make sure that you have a solid, determined, preset risk management plan, know what your position sizing looks like, know how much leverage to use or not use. I highly recommend only spot trading, especially if you're a brand new trader, because you will lose your account so quickly. I really cannot begin to emphasize how important this is. When I first started trading, I was of the utmost arrogance and confidence that I was able to do well. The worst thing that could have happened to me was the fact that I had some early success and did very, very well in the beginning. And then I grew overly confident management, and honestly grew a little bit lazy with my risk management position sizing, and then really kind of took on some unnecessary but really, really significant losses. That's really my motivation for putting this course together. So if I can help you prevent any of the mistakes that I made, then I'm winning, and then I'm doing my part here. So let's go ahead and get moving here. So in any Telegram group or wherever you're getting your chart ideas from TradingView, wherever, the thing is, they will be set up fairly differently depending on where you're getting your ideas. But in my group, in the Crypto Revolution group, and in a lot of other trading groups, the chart premise is very simple. Okay, so here's an example of an idea I posted a little bit back about Bitcoin. So one thing we'll do is we'll identify the pattern here. So here we had a trading range, a consolidation pattern, and then here are potential aggressive buy entries. Now, aggressive buy means that price action could fall right below that price, and it's exactly what it is. It's an aggressive buy. It means you're taking on a little bit more risk to enter into a trade by purchasing or entering into a long or short trade at these aggressive buy levels. Now, the aggressive buys will, in fact, produce higher returns, but they also carry with them higher risks. So that's just a common trend in all trading. If you're going to win higher returns on your trade ideas, then typically the trade ideas are a bit more risky than safer ones. So in this charting idea, the volume confirmed breakout above this line would indeed be the much safer bet, really letting you know that you might not do as well. You might even get a fake out. Now, if you finish this course in chapter 6, we do talk about how to buy the breakout. So please make sure you finish this course really before you start risking any real capital. All right. So again, here it's pretty fairly simple. Now, the idea here is for you to calculate the risk reward that you would like to enter on your own. And you can do that fairly simple. Now, you can go to your TradingView chart here. And one thing you can do is click on the left-hand side and you'll get this long position. And this will give you a risk reward idea of a potential trade. Okay, so you'll put your entry price right at the middle, your stop loss here, and your expected target price. That will give you a risk reward ratio. Now, it's highly recommended that you stick to a risk reward ratio somewhere above 3, especially since, trading fees, funding rate, things like that should be taken into consideration, because if your funding rate is too high, then you might be entering into a technically profitable long position, but when you close the position, the funding rate might not be up to par, and you could actually end up losing money on potentially profitable trades. Kind of confusing, I know, but it's just the way it is. So in this trade setup idea here, you can see we have a stop loss at a very significant stop loss position. It is down below this area of resistance. And what's not pictured here in the chart are some moving averages that the stop loss is below. And then we have a few targets up here with the final take profit up here at $56,578. And then if price action does make it up to this final target, it would be a 19% gain from this aggressive buy area right here, giving us a fairly decent risk reward ratio and a fairly decent trade entry. Now, how much to risk should be predetermined in your own risk management plan. Your position sizing is all up to your level of risk tolerance that you're willing to take on. Again, don't gamble, don't bet it all on the farm. As you move through this course, I will show you how to put together a fairly meticulous trading plan, how much to risk, when to risk it, not necessarily how much to risk, but how to determine that on your own so that, you can not take significant losses on losing trades. Granted, you may not take significant wins on winning trades, but the idea is capital preservation, winning more trades than losing, and working your way up to an increased account. Or really, you can limit your trades and only take nice swing trades. Now, those will be things that I do post in the group pretty often, but with this Bitcoin bull market jumping in at pretty precise times can be the difference between losing money and making money in the end. Okay, so the best thing to do here is to analyze this chart, develop your own risk reward, calculate your own position sizing, and then you'll enter limit buys if you're going to do the aggressive buy. And then on the breakout, one thing you'll be looking for, and we will go over this in chapter 5, is the breakout, volume confirmation, retest of this upper resistance, turn support, and then price action should continue to the upside. That's where you'll place your limit buy orders and hope to catch a small pullback on the way back down, confirming this overhead resistance as new support before price action moves to the upside. All right, so I hope you're able to read these charts, understand these trading ideas. And again, in this week's live lecture, we will go over how to understand and read these charts, how to put them to work, how to find confluence with your own personal ideas, and really try to grasp how traders are coming up with these potential ideas. All right, so that's it. Let's move on. Let's get this chapter going. Thanks again for dropping in. Thanks again for taking the course. I really hope this benefits you. And I really hope that my TA and analysis in the group also benefits you. All right, let's go. What are trading pairs in crypto? So in crypto, trading pairs or crypto pairs are assets that can be traded for each other on an exchange. For example, Bitcoin Litecoin pair, BTC LTC, or the Ethereum Bitcoin Cash pair, ETH BCH. Trading pairs let you compare costs between different cryptos. Now, in this lesson, we're going to go over how these crypto trading pairs work, and what is a base currency and why it is important. So how do crypto trading pairs work? Crypto pairs allow you to compare costs between different cryptos. These pairings help illustrate the relative worth of coins. For example, how much Bitcoin equals in Ethereum and how much Ethereum equals in Bitcoin Cash. Exchanges usually offer several pairing options, giving you the chance to choose a pairing based on currencies you already possess. For example, if you own Bitcoin, then you have the opportunity to trade with any pairing listed on an exchange that includes Bitcoin. Some crypto exchanges do not offer pairings for cryptos and fiat currencies like the USD, but exchanges like Gemini, Coinbase, Binance, and Kraken do offer fiat trading pairs, as they have the most exchange options. The most versatile cryptocurrency pairs to trade are usually Bitcoin and Ethereum. So what is a base currency and why is it important? To fully take advantage of crypto trading pairs, you need to understand what a base currency is. A base currency is a way to denote an agreed upon value of different assets. Base currencies are a common tool for comparing exchange rates across fiat currencies in different countries. An American traveling to Italy will want to convert USD into the Italian currency, the euro. In this case, the USD serves as the base currency. The same principles apply to crypto assets. If you're seeking a lesser known crypto on an exchange, you'll likely need to own one of the base currencies listed in a pair before you can trade it. In most cases, the most popular are Bitcoin and Ethereum. They serve as base currencies, but accepted base currencies will vary for each exchange. Now, before diving into trading pairs, investors should confirm which base currencies are accepted at their exchange and which base currencies are accepted as a choice, as well as which trading pairs the exchange offers. Now, in addition, many exchanges offer stablecoin trading pairs such as USDT and USDC, usually pegged to the US dollar. Now, these stablecoins may hold one-to-one physical reserves of the USD or use another mechanism such as DAI. What is a trend? Now, a trend is the overall direction of a market or an asset's price. In technical analysis, trends are identified by trend lines or price action that highlights when the price is making higher swing highs and higher swing lows for an uptrend, or lower swing lows and lower swing highs for a downtrend. Now, many traders opt to trade in the same direction as a trend, while contrarians seek to identify reversals or trade against the trend. Uptrends and downtrends occur in all markets, such as stocks, bonds, futures, and crypto. Trends occur in in data, such as when monthly economic data rises or falls from month to month. Some takeaways from this lesson. Now, a trend is the general direction of the price of a market, asset, or metric. Uptrends are marked by rising data points, such as higher swing highs and higher swing lows. Downtrends are marked by falling data points, such as lower swing lows and lower swing highs. Traders may opt to trade in the same direction as the trend, attempting to profit from a continuation of that trend. Price action, trend lines, and technical indicators are all tools that can help identify the trend and warn when it will be reversing. Now, how do trends work? Traders can ID a trend using various forms of technical analysis, including trend lines, price action, and indicators. For example, trend lines might show the direction of a trend, while the RSI is designed to show the strength of a trend at any given point in time. Now, an uptrend is marked by an overall increase in price. Nothing moves straight up for long. There will always be oscillations, but the overall direction needs to be higher in order for it to be considered an uptrend. Recent swing lows should be above prior swing lows, and the same goes for swing highs. Once this structure starts to break down, the uptrend could be losing steam or reversing into a downtrend. Downtrends are composed of lower swing lows and lower swing highs. While the trend is up, traders may assume it will continue until there is evidence that points to the contrary. Such evidence could include lower swing lows or highs, the price breaking below a trend line, or technical indicators turning bearish. While the trend is up, traders focus on buying, attempting to profit from a continued price rise. When the trend turns down, traders focus more on selling or shorting, attempting to minimize losses or profit from the price decline. Now, most, not all, downtrends do reverse at some point, so as the price continues to decline, more traders begin to see the price as a bargain and step in to buy. This could lead to the emergence of an uptrend again. Now, trends may also be used by investors focused on fundamental analysis. This form of analysis looks at changes in revenue, earnings, or other business or economic data. For example, fundamental analysts may look for trends in earnings per share and revenue growth. If earnings have grown for the past 4 quarters, this represents a positive trend. However, if earnings have declined over the past 4 years, this represents a negative trend. The lack of a trend, that is, a period of time where there is a little overall upward or downward progress, is called a range or trendless period. Now, using trend lines. A common way to identify trends is using trend lines, which connect a series of highs, downtrend, or lows in an uptrend. Uptrends connect a series of higher lows, creating a support level for future price movements. Downtrends connect a series of lower highs, creating a resistance level for future price movements. In addition to support and resistance, these trend lines show the overall direction of the trend. Now, while trend lines do a great job of showing the overall direction, they will often need to be redrawn. For example, during an uptrend, the price may fall below the trend line, yet this doesn't necessarily mean that the trend is over. The price may move below the trend line and then continue rising. In such an event, the trend line may need to be redrawn to reflect the new price action. Trend lines should not be relied on exclusively to determine the trend. Most professionals also tend to look at price action and other technical indicators to help determine if a trend is ending or not. In the example we talked about here, a drop below the trend line isn't necessarily a sell signal, but if the price also drops below a prior swing low and or technical indicators are turning bearish, then in fact it might be. Now, example of a trend and a trend line. The following chart. In this chart, we're going to show you how a rising trend line along with an RSI reading that suggests a strong trend. While the price is oscillating, the overall progress is to the upside. The rising trend begins to lose momentum and the selling pressure kicks in. The RSI falls below 70, followed by a very large down candle that takes the price to the trend line. The move lower was confirmed the next day when the price gapped below the trend line. These signals could have been used to exit long positions, and as there was evidence that the trend was turning, short trades could have also been initiated. Now, as the price moves lower, it starts to attract buyers interested in the lower price. Another trend line could also be drawn along the falling price to indicate when a bounce may be coming. All right, welcome to lesson number 14. In this one, we are going to go over trend lines, what they are, and how to draw them, and how to use them in your trading strategy. So, trend lines explained. What are trend lines? In financial markets, trend lines are diagonal lines drawn on charts, very simply. They connect specific data points, making it easier for chartists and traders to visualize price movements and identify market trends. Trend lines are considered one of the most basic tools in technical analysis. They are widely used in stock trading, fiat currency trading, derivatives, and cryptocurrency markets. Now, essentially, trend lines work like support and resistance levels, but are made of diagonal instead of horizontal lines. As such, they can have either a positive or a negative slope. Now, in general, the greater the slope of the line, the stronger the trend is. We can divide trend lines into two basic categories: ascending or an uptrend, or descending and a downtrend. As the name suggests, an uptrend line is drawn from a lower to a higher chart position. It connects two or more low points, as this illustration suggests. In contrast, a downtrend line is drawn from a higher to a lower position in the chart. It connects two or more high points. So the difference between the two types of lines is the selection of the points that are used to draw them. In an uptrend, the lines will be drawn using the lowest points in the chart, i.e. candlestick bottoms forming higher lows. On the other hand, downtrend lines are drawn using the highest values, i.e. candlestick tops forming lower highs. So how to use trend lines? So based on the highs and lows of a chart, trend lines indicate where the price briefly challenged the prevailing trend, tested it, and then turned back in its favor. The line can then be extended to try and predict important levels in the future. The trend line may be tested several times, but as long as it is not broken, it is considered valid. Now, while trend lines can be used in all kinds of data charts, they are usually applied to financial charts based on market prices. They provide insight into the market supply and demand, and naturally, upward trend lines indicate an increasing buying force. Basically, demand is higher than the supply. Downward trend lines, in contrast, are associated with consistent price drops, suggesting the absolute opposite: supply is higher than demand. However, the trading volume should also be considered in such analysis. For instance, if the price is increasing but the volume is decreasing or relatively low, it may give a false impression of increased demand. Now, as mentioned, trend lines are used to identify support and resistance levels, which are two basic but very important concepts of technical analysis. An uptrend line shows support below which the price is unlikely to drop. In contrast, the downtrend line highlights resistance levels above which the price is unlikely to rise. In other words, the market trend may be considered invalid when the support and resistance levels are broken, either to the downside for an uptrend line or to the upside for a downtrend line. In many cases, when these key levels fail to hold the trend, the market tends to change direction. Still, technical analysis is a subjective field, and each person may present a completely different method for drawing trend lines. Thus, it may be worth combining multiple technical analysis techniques as well as fundamental analysis to reduce your risk. Now, drawing a valid trend line. Technically, trend lines can connect any 2 points in a chart, but most chartists agree that using 3 points or more is what makes a trend line valid. In some cases, the first 2 points can be used to define a trend in potential, and the third point, extended in the future, can be used to test its validity. Now, so when the price touches the trend line 3 or more times without breaching it, the trend can be considered valid. Testing the trend line multiple times indicates that maybe the trend is not a mere coincidence caused by price fluctuations. Now, scale settings. In addition to choosing enough points to create a valid trend line, it is important to consider proper settings when drawing them. Among the most important chart setting is the scale settings. In financial charts, the scale relates to the manner in which the change in price is displayed. The two most popular scales are arithmetic and semi-logarithmic. On an logarithmic chart, change is expressed evenly as the price moves up or down the y-axis. In contrast, semi-log charts express variation in terms of percentage. For example, a price change from $5 to $10 would cover the same distance on an arithmetic chart as one from $120 to $125. On a semi-log chart, however, the 100% gain, $5 to $10, would occupy a much larger portion of the chart as opposed to the 4% increase of the $120 to $125 move. Now, it is important to consider the scale settings when drawing trend lines. Each type of chart may result in different highs and lows and thus slightly different trend lines. While they are useful tools for technical analysis, trend lines are far from foolproof. The choice of points used to draw trend lines will affect the degree to which they accurately represent market cycles and real trends, making them somewhat subjective. For instance, some chartists draw trend lines based on the body of the candlesticks, disregarding the wicks. Others prefer to draw lines according to the highs and lows of the wicks. So it's important to use trend lines in conjunction with charting tools and indicators. All right. So if you're drawing trend lines, you want to make sure you're using either candle body wicks or candle bodies. And you want to make sure there are at least 3 points of contact for a valid trend line. The concepts of support and resistance are some of the most fundamental topics related to technical analysis in any market. They apply essentially to any market, whether that's stocks, forex, gold, or crypto. Now, while they're simple concepts to really understand, they're actually quite difficult to master, and identifying them can be entirely subjective, and they'll work differently in changing market conditions, and you'll need to understand their different types. But above all, you will need to study a lot of charts, and this lesson will help you get started. Now, what are support and resistance? On the most fundamental level, support and resistance are simple concepts. The price finds a level that it's unable to break through, with this level acting as a barrier of some sort. In the case of support, price finds a floor, while in the case of resistance, it finds a ceiling. Basically, you could think of support as a zone of demand and resistance as a zone of supply. Now, while more traditionally, support and resistance are indicated as lines, the real world cases are usually not as precise. Keep in mind, the markets aren't driven by some physical law that prevents them from breaching a specific level. This is why it may be more beneficial to think of support and resistance as areas. You can think of these areas as ranges on a price chart that will likely drive increased activity from traders. Let's go ahead and look at an example of a support level. Note that the price continually entered an area where the asset was bought up. A range support was formed as the area was retested multiple times. And since the bears, or the sellers, were unable to push the price further down, it eventually bounced, potentially starting a new uptrend. Now let's look at a resistance level. As we can see, the price was in a downtrend, but after each bounce, it failed to break through the same area multiple times. The resistance level is formed because the bulls, or the buyers, are unable to gain control of the market and drive the price higher, causing the downtrend to continue. Now, how can traders use support and resistance levels in their technical analysis? Basically, they're used to identify areas of interest on a price chart. These are the levels where the likelihood of a reversal or a pause in the underlying trend may be higher. Now, market psychology plays a huge part in the formation of support and resistance levels. Traders and investors will remember the price levels that previously saw increased interest in trading activity. Now, since many traders may be looking at the same levels, these areas might bring increased liquidity. This often makes the support and resistance zones ideal for large traders or whales to enter or exit positions. Now, support and resistance are key concepts when it comes to exercising proper risk management. The ability to consistently identify these zones can present favorable trading opportunities. Typically, two things can happen once the price reaches an area of support or resistance. It either bounces away from the area or breaks through it and continues in the direction of the trend, potentially to the next area of support or resistance. Now, entering a trade near a level of support or resistance area may be beneficial to your strategy, mainly because of the relatively close invalidation point, where we usually place a stop loss. Now, if the area is breached and the trade is invalidated, traders can cut their loss and exit with a small loss. In this sense, the further the entry is from the zone of supply and demand, the further the invalidation point is. Something else to consider is how these levels may react to changing context. As a general rule, a broken area of support may turn into an area of resistance when broken, and conversely, if an area of resistance is broken, it may turn into a support level later when it's retested. So these patterns are sometimes called SR flips or support resistance flips. Now, the fact that the previous support zone acts as resistance for now or vice versa confirms a pattern. As such, the resistance of the area may be a favorable place to enter into a position. Another thing to consider is the strength of a support and or resistance. Another thing to consider is the strength of a support or resistance area. Now, typically, the more times the price drops and retests a support area, the more likely it is to break to the downside. And similarly, the more times the price increases and retests a resistance area, the more likely it is to break to the upside. So we've gone through how support and resistance works when it comes to price action. But what other types of support and resistances are out there? Let's go over a few of them. Psychological support and resistance. Now, the first type we'll discuss is called psychological support and resistance. These areas don't necessarily correlate with any technical pattern, but exist because of how the human mind tries to make sense of the world. Now, in case you haven't noticed, we live in a staggeringly complex place. As such, we inadvertently try to simplify the world around us so we can make more sense of it. And this includes rounding numbers up. Have you ever thought to ask yourself that you have a craving for 0.7648 of an apple, or ask a merchant for 13,678,254 grains of rice? No. A similar effect is at play in the financial markets. It's especially true for cryptocurrency, which involves easily divisible digital units. Buying an asset at $8.67.4 and selling it at 9.9765 just isn't processed the same as buying it $8 and selling it $10. This is why round numbers can also act as support and or resistance on a price chart. Well, if only it'd be that simple. The phenomenon has become well known over the years. As such, traders might try to front run obvious psychological support or resistance areas. Front running in this case means placing orders just above or below an anticipated area of support or resistance. Take a look at this example. So the DXY approaches 100 on the index. Some traders place sell orders just below that level to make sure those orders are filled. Because so many traders expect a reversal at 100 and many front run the level, the bear market never reaches it and reverses just before. Now, trend line support and resistance. So if you have been following along, you know that patterns will also act as barriers for price. In this example, an ascending triangle keeps the price contained until the pattern breaks to the upside. So you can use these patterns to your advantage and identify areas of support and resistance that coincide with trend lines. They can be especially useful if you manage to spot them early, before the pattern is fully developed. Now, moving average support and resistance. Many indicators also provide support and resistance when they interact with the price. One of the most straightforward examples of this are moving averages. As a moving average acts as support or resistance for the price, many traders use it as a barometer for the overall health of the market. Moving averages may also be useful when trying to spot trend reversals or pivot points. Here's an example of the 200 weekly moving average acting as support for the price of Bitcoin. Fibonacci support and resistance. Levels outlined by the Fibonacci retracement tool may also act as support and resistance. In this example, you see that the 61.8 Fibonacci level acts as support multiple times while the 23.6 level acts as resistance. This is Fibonacci support and resistance. Now, what is confluence in technical analysis? So far we've discussed what support and resistance are and some of their different types, but what's the most effective way to build trading strategies around them? A key thing to understand is a concept called confluence. Confluence is when a combination of multiple strategies are used together to create one strategy. Support and resistance levels tend to be the strongest when they fall into multiple of these categories that we've discussed. Now let's consider this through two examples. Which potential support zone do you think has a higher chance to actually act as support? Support number one coincides with a previous resistance area, an important moving average, a 61.8 Fibonacci level, and a round number in price. Support number two coincides with a previous resistance area, a round number in price. If you've been paying attention, you'll correctly guess that support number one has a higher chance of holding the price. Now, while this may be true, the price could also fly right through it. The point here is that probability of it acting as support is higher than it is for support number two. With that said, there are no guarantees when it comes to trading. None. Not a single damn one. And while trading patterns can be helpful, past performance does not imply future performance. So you should be prepared for all possible outcomes. Now, historically, the setups that are confirmed by multiple strategies and indicators tend to provide the best opportunities. Some successful confluence traders might be very picky about what setups they enter, and it often involves a lot of waiting. However, when they do enter trades, their setups tend to work out with a higher probability than those that don't. Even so, it's always essential to manage risk and protect your capital from unfavorable price movements. Even the strongest looking setups with the best entry points have a chance of going the other way. It's important to consider the possibility of multiple scenarios so you don't fall into false breakouts or bull and bear traps. Now, regardless if you're a day trader or a swing trader, support and resistance are fundamental concepts to understand when it comes to TA. Now, support acts as a floor for price while resistance acts as a ceiling. Different forms of support and resistance can exist, and some are based on the interaction of price with technical indicators. The most reliable support and resistance areas tend to be those that are confirmed by multiple strategies or have what we call confluence. All right, we are on video number 15, moving right along here in chapter 2. Let's get right into today's lesson. So what is a candlestick? A candlestick is a type of price chart used in technical analysis that displays the high, low, open, and closing prices of a security for a specific period. It originated from Japanese rice merchants and traders to track market prices and daily momentum hundreds of years before becoming popularized by the United States. The wide part of the candlestick is called the real body, and it tells investors whether the closing price was higher or lower than the opening price. All right, so the basics of a candlestick. The candlestick's shadow shows the daily high and low and how they compare to the open and close. A candlestick's shape varies based on the relationship between the day's high, low, opening, and closing prices.
The next type of chart is the Japanese candlestick, And this was really first used by a gentleman by the name of Morihisa Homa. He was a Japanese rice futures trader back in the 1700s. And we're going to talk about a little bit about how these candlesticks are constructed. They're very similar to the bar chart in that you have a high, a low, an open, and a close. But from a visualization standpoint, the candlestick is going to tell us a story, okay? So we're going to use days for periods just to keep things simple. So let's say this candlestick is a given day. You have a hollow candle and you have a filled candle. So let's talk about what the differences are. The high of the day, of course, and the low of the day is the same in both types of charts. But if you have a hollow candlestick, this is what's called the real body. If the real body is not filled and it's hollow, that means that the closing price is above the opening price. In the case of a filled candle, where the candle has essentially melted, it is indicating to us that the opening price is above the closing price. So hollow candle, we have the close above the open, and a filled candle, the close below the open. Whether it's up or down on that given day based on the prior period's close is irrelevant when it comes to the hollow and the filled construction of the candlestick. This is only to do with the period that we're discussing. Here's a great example of a filled candlestick. In this case, the open was here. This was the high of the day, which intraday went even higher. Closed near the lows of the day, but not quite towards the bottom. In this case, it's basically the exact same candlestick, except one's hollow and one's filled. So in this case, it's the opposite. It opened near the lows of the day and went out on the day near the highs. We had a little bit of a spike intraday that it didn't quite reach there on the close, and we had a little bit of a dip below the open. But at the end of the day, we went out near the highs. This is something that we describe as a bullish candlestick. This melted candlestick would be even more bearish. Here's another great example where we have a long shadow. That wick on top of the candlestick is what we call a shadow. The longer it is to the upside, the more the reversal, the more the sellers took control of that specific period. So while this is bullish and this is bearish, I would argue that something like this that reversed this dramatically would be even more bearish. Now we're going to talk about the individual colors of the chart. And I think that this is something that's not explained very often. Here we have green candlesticks and we have red candlesticks. The colors of the candlesticks are determined based on where the price is compared to where it was in the prior period. Okay? So if we're looking at a daily chart and the candlestick is green, that means the closing price for that day was above the previous day's close. It has nothing to do with where it closed based on the open. The color is simply based on where it closes relative to the prior period. Now, remember, we can have hollow red candles just like we can have filled green candles. So in this case, let's look at an example of a red hollow candle. In this case, we have a closing price in the prior day. The opening price is substantially lower. So the stock gaps lower the following day, rallies throughout the entire day to close near the highs. So since it closed above the open, it is a hollow real body. But since the close is below the previous day's close, it's going to be red. Here's the opposite. In this case, we have a green filled candle. So on this particular day, the market went out near the highs of the day. And what this candle is suggesting to us is that the following day, the market gapped up to open substantially higher than the previous closed, however, melted throughout the rest of the day to close near the lows. But since it closed still near the lows of the day, but above the prior day's close, it's going to remain green. So let's remember that the color has nothing to do with where it closes based on the open, but where it closes based on the prior close. So there are 4 types of candlesticks that we're essentially accustomed to seeing: green hollow ones, red hollow ones, green filled ones, and red filled ones. So let's go over this again. If you have a green hollow candle, that means the close is above the opening price, and the close is also above the prior close. The red hollow candle is going to close above the opening price, but below the prior day's close. The green filled candle is going to close below the open, but still above the prior day's close. And the red filled candle is going to close below the open as well as below the prior day's close.
All right, we are almost through chapter 2 and things are going to start getting a bit more interesting. So if you've made it this far, congratulations and great work, because all of this boring stuff that usually comes in the beginning is almost done. So let's go ahead and get right into video number 16. This video is going to be all about moving averages. So moving averages are pretty important in any trader's strategy. From traditional portfolios to cryptocurrencies like Bitcoin and Ethereum, the use of technical analysis indicators have one simple goal. That is to use existing data to make more informed decisions that will likely lead to desired outcomes. As markets grow increasingly more complicated, the last decades have produced hundreds of different types of technical analysis indicators, but few have seen the popularity and consistent usage of the moving average. Now, although there are different variations of moving averages, their underlying purpose is to drive clarity in trading charts. This is done by smoothing out the graphs to create an easily decipherable trend indicator. Because these moving averages rely on past data, they are considered to be lagging or trend following indicators. Regardless, they still have great power to cut through the noise and help determine where a market may be heading. Now, different types of moving averages. There are various types of moving averages that can be utilized by traders not only in day trading and swing trading, but also in longer term setups as well. Despite the various types, the moving averages are most commonly broken down into two separate categories. We have the simple moving averages, or the SMAs, and the exponential moving averages, or the EMAs. Depending on the market and desired outcome, traders can choose which indicator will most likely benefit their setup.
The moving average is a tool commonly used by traders and technical analysts to analyze the price movement of securities. The moving average is simply an average of a series of data points over a given period of time. Traders use moving averages to smooth out fluctuating data in order to identify overall trends and cycles. There are two types of moving averages that are most commonly used by traders: the simple moving average, SMA, and the exponential moving average, EMA. The simple moving average is the mean of the data points. For example, if you were using a 20-day moving average on stocks, the price for each of the past 20 days would be added together and then divided by 20 to generate the moving average. As new price data is added each day, the 20-day moving average shifts forward, always using the latest 20 available data points. Each data point is weighted equally in the simple moving average, regardless of whether it happened yesterday or 20 days ago. Similarly, an exponential moving average will also take an average of the data points over a given period of time, like the simple moving average. However, the weighting of each data point is not equal. More weight is given to the most recent data, and the weightings decrease as you go farther back in time. In other words, the exponential moving average treats recent data as more relevant and more important compared to historical data. In investing, traders are always looking for signals to buy or sell. By weighting recent data more heavily, exponential moving averages can give traders clear trend signals faster than the simple moving average. However, this can also increase the number of false signals. For this reason, many traders use an exponential moving average in combination with a simple moving average.
Now, how to use moving averages. So because moving averages utilize past prices instead of current prices, they have a certain period of lag. The more expansive the data set is, the larger the lag will be. For example, a moving average that analyzes the past 100 days will respond more slowly to new information than a moving average that only considers the past 10 days. That's simply because a new entry into a larger data set will have a smaller effect on the overall numbers. both can be advantageous depending on the trading setup. Larger data sets benefit long-term investors because they are less likely to be greatly altered due to one or two large fluctuations. Short-term traders often favor a smaller data set that allows for more reactionary trading. Now, within traditional markets, moving averages of 50, 100, and 200 days are the most commonly used. The 50-day and 200-day MAs are closely watched by stock traders, and any breaks above or below these lines are usually regarded as important trading signals, especially when they are followed by crossovers. The same applies to cryptocurrency trading, but due to its 24/7 volatile markets, the MA settings and trading strategy may vary according to the trader's profile. Crossover signals. So naturally, a rising moving average suggests an uptrend and a falling MA indicates a downtrend. However, a moving average alone is not a really reliable, strong indicator. Therefore, MAs are constantly used in combination to spot bullish and bearish crossover signals. A crossover signal is created when two different MAs cross over in a chart. The bullish crossover, also known as the golden cross, happens when the short-term MA crosses above a long-term one, suggesting the start of an upwards trend. In contrast, a bearish crossover, or a death cross, happens when a short-term MA crosses below a long-term MA, which indicates the beginning of a downtrend. Now, some other factors worth considering. The examples so far have all been in terms of days, but that's not a necessary requirement when analyzing moving averages. Those engaged in day trading may be much more interested in how an asset has performed over the past 2 or 3 hours, not 2 or 3 months. Different time frames can all be plugged into the equations used to calculate moving averages, and as long as those time frames are consistent with the trading strategy, the data can be useful. One major downside of MAs is their lag time. Since moving averages are lagging indicators that consider previous price action, the signals are often too late. For instance, a bullish crossover may suggest a buy, but it may only happen for a significant rise in price. This means that even if the uptrend continues, potential profit may have been lost in that period between the rise in price and the crossover signal. Or even worse, a false golden cross may lead to a trader to buy the local dip just before a price drop. These fake buy signals are usually referred to as a bull trap. Now, moving averages are powerful TA indicators and one of the most widely used. The ability to analyze market trends in a data-driven manner provides great insight into how a market is performing. Keep in mind, however, that moving averages and crossover signals should not be used alone, and it is always safer to combine with different TA indicators in order to avoid fake signals. Okay, so in the previous video, we briefly touched on golden and death crosses. Now, what is a golden cross and what is a death cross, and how can you use them in your strategy? Well, a golden cross or golden crossover is a chart pattern that involves a short-term moving average crossing above a long-term moving average. Typically, the 50-day moving average is used as the short-term moving average, and the 200-day moving average is used as the long-term moving average. However, this isn't the only way to think about a golden crossover. It can happen on any time frame, and the basic idea is that a short-term average crosses over a long-term average. Now, typically, a golden cross happens in 3 phases. The short-term MA is below the long-term MA during a downtrend. The trend reverses and the short-term MA crosses above the long-term MA, and an uptrend starts when the short-term MA stays above the long-term MA. So in many cases, a golden cross may be considered a bullish signal. Why? The idea is simple. We know that a moving average measures the average price of an asset for the duration that it plots. In this sense, with a short-term MA is below a long-term MA, it means that the short-term price action is bearish compared to the long-term price action. Now, what's happening when the short-term average crosses above the long-term average? The short-term average price goes higher than the long-term average price. This indicates a potential shift in the direction of the market trend, and this is why a golden cross is considered bullish. Now, in the conventional interpretation, a golden cross involves a 50-day moving average crossing above the 200-day moving average. However, the general idea behind the golden cross is that a short-term moving average crosses over a long-term moving average. In this sense, we could also have golden crosses happening on other time frames, the 15-minute, the 1 hour, and the 4 hour, etc. Still, higher time frame signals tend to be more reliable than lower time frame signals. So far, we've considered a golden cross with what's called a simple moving average. However, there is another popular way to calculate a moving average called the EMA. This uses a different formula that we spoke about in the last video. Now, EMAs can also be used to look for bullish and bearish crossovers, including the golden cross. Now, as EMAs react more quickly to recent price movements, the crossover signals that they produce may be less reliable and present more false signals. Even so, EMA crossovers are popular among traders as a tool for identifying trend reversals. Now, what is a death cross? A death cross is basically the exact opposite of a golden cross. It's a chart pattern where a short-term moving average crosses below a long-term moving average. For example, the 50-day MA crosses below the 200-day MA. As such, a death cross is typically considered to be a bearish signal. Now, typically, a death cross happens in 3 phases as well. The short-term MA is above the long-term MA during an uptrend. The trend reverses and the short-term MA crosses below the long-term MA. A downward trend starts when the short-term moving average stays below the long-term moving average. So now that we understand what a golden cross is, it is fairly easy to understand why a death cross is a bearish signal. Now, the short-term average is crossing below the long-term average, which indicates a bearish outlook on the market. Now, the death cross has provided a bearish signal before major economic downturns in history, such as in 1921 or in 2008. However, it may also provide false signals, for example, 2016. Now, as you can see on the example, the market printed a death cross only to resume the uptrend and print a golden cross shortly thereafter. So, golden cross versus a death cross. Really, what is the difference? Well, we've discussed them both. So the difference between them isn't difficult to understand. They are essentially the polar opposites of each other. The golden cross may be considered a bullish signal, while the death cross may be considered a bearish signal. Now, both of them can be confirmed by high trading volume. Some technical analysts may also check other indicators when looking at the crossover context. Some common examples include using the MACD and the RSI. Now, what's also important to remember here is that the moving averages are lagging indicators and have no predictive power. This means that both crossovers will typically provide a strong confirmation of a trend reversal that has already happened, not a reversal that is still underway. How to trade the golden cross and the death cross? Well, the idea behind these patterns is really quite straightforward. If you know how to trade using the MACD, you'll easily understand how to trade these crossover signals. Now, when we're talking about the conventional golden cross and death cross, we are usually looking at the daily chart. So a simple strategy could be to buy at a golden cross and sell at a death cross. In fact, this would have been a relatively successful strategy for trading Bitcoin in the last few years, though there were many false signals along the way. As such, blindly following one signal is typically not the best strategy. So you might want to consider other factors when it comes to market analysis techniques. The crossover strategy we spoke about in the previous lesson is based on daily moving averages. But what about other time periods, you might be thinking? Well, golden crosses and death crosses happen just the same, and traders can take advantage of them. However, as with most chart analysis techniques, signals on higher time frames are always stronger than signals on lower time frames. A golden cross may be happening on the weekly time frame while you're looking at a death cross happening on the hourly time frame. This is why it's always helpful to zoom out and look at the bigger picture on a chart. taking multiple readings into account. Something many traders will also look for when trading golden crosses and death crosses is the trading volume. Now, as with other chart patterns, the volume can be a strong tool for confirmation. As such, when a volume spike accompanies a crossover signal, many traders will be much more confident that the signal is valid. Now, once a golden cross happens, the long-term moving average may be considered as a potential area of support. Conversely, once a death cross happens, it may be considered a potential resistance area. Now, crossover signals may also be cross-checked with signals from other indicators to look for confluence. Confluence traders combine multiple signals and indicators into one strategy in an attempt to make the trade signals that much more reliable. Now, we've discussed some of the most popular crossover signals, the golden and the death cross. In short, a golden cross involves a short-term MA crossing above a long-term MA, and conversely, a death cross involves a short-term MA crossing below a long-term MA. They both can be used as reliable tools for confirming long-term trend reversals when it comes to crypto, the stock market, and Forex. All right, welcome to lesson number 17 to wrap up chapter 2. Congratulations for making it this far. This is actually a very, very important lesson. So make sure you download or access the trading journal and the pattern diary that go with this chapter and lesson. All right, let's dive into this. So what is a trading journal and how the hell should I use one? So trading journals can be extremely useful and play a pretty central role in the trading plans of most professional traders. Now, things like planning future trades, documenting existing positions, and recording any emotions that may pop up are essential to be aware of when building a profitable trading strategy. Therefore, knowing how to create and use a trading journal is crucial to any trader's success. And without it, a trader could easily lose track of his or her winning or losing positions. Or even worse, they could blow up their entire trading account. Now, what is a trading journal? So a trading journal consists of a document where everything you do as a trader is recorded, including strategy development, risk management, psychology, and more. Keeping a trading journal is easy but very effective if created and used correctly. Now, while it can bring valuable insights that may prevent your account from blowing up, it can also be the reason for your account going to the moon. Now, there are several important reasons why keeping a trading journal is important. Here are some of those. Now, it keeps you accountable. It makes you more disciplined and consistent. It helps you spot profitable trading strategies. It documents your strengths and weaknesses, and it makes you much more careful when analyzing potential trades. Now, successful traders plan all of their trades meticulously and document the successes and the failures of their trading performance. By creating a trading journal and using it correctly, you can become a successful trader regardless of how the market moves. Now, how would you create a trading journal? So you can find a free trading journal that is included with this lesson, but it's also important to learn how to create one. And you can customize your trading journal in a variety of formats to fit your trading style and your needs. As long as you have somewhere to plan and document your trading activities, you'll be all set. So first, you need to create a trading journal spreadsheet. You can use Google Sheets, Microsoft Excel, whatever, and a written document. So you'll use Google Docs or Microsoft Word. You'll be using these to record your exact trades and your thoughts, respectively. Now, if you prefer, you can include the written document as a second tab in the spreadsheet, or do anything like that. Second, you'll need to know what you'll be recording daily so your trading journal will have the highest possible impact on your success. You can find several trading journal examples online, but regardless of the template, your spreadsheet should have columns related to each trade. Some ideas for these columns include the entry date, exit date, symbol, direction, whether you're going long or short, entry price, position size, notional value, stop loss, take profit price, your exit price, trading fees, profit and loss percentage, and then of course some notes. So some traders may also add this add time frame, screenshots of the setup, and anything else they may deem important. The bottom line is for the information to work in your favor. In your written document or on another tab, you should have a section for each day where you can write down all of your thoughts and ideas and get them organized. The written document is where a trader lets loose their creativity, while their spreadsheet helps to measure the profitability of their creativity. Both are very useful when creating and using a trading journal. And that's it. Learning how to create a trading journal is the easy part, though. Knowing how to use a trading journal is something you'll need to get good at over time. However, as long as you have a strong understanding of the fundamentals, you'll be using your trading journal like a pro in no time. How to use a trading journal. It's one thing to create a trading journal, but it's an entirely other thing to know how to implement what you learn from it onto your trading system. Using a trade journal effectively can turn an unprofitable trader into a profitable one. So before you enter into any trade, you need to have a good reason for doing so. This is where your written document comes in handy. Every day when you look at the market, ideas are going to be popping up in your head and feelings will be flowing through your body. You need to get those ideas and feelings written down so you can spot anything that could either help or hinder your trading performance. This could include general market behavior, past trades, present trades, and potential trades. Now, your written document is also where you'll be making the argument over whether a specific trade idea you have is good or not. Now, your trade ideas should be turned upside down and inside out so you can spot the strengths and weaknesses of each one. Once you've got your thoughts and emotions written down, it's time to turn to your spreadsheet. So your spreadsheet is less of a creative space than your written document and much more of a logical space. This is where you'll be recording all of your trades, so it's important that you keep it neatly organized and up to date. An important factor in having a successful trading journal is measuring your success and failures accurately. With your spreadsheet, you should ensure you keep accurate records so you can gauge whether the ideas you developed in your written document are profitable or not. A good habit to get into is to record your trades the moment after you execute them. That's when they'll be fresh in your mind and you'll save yourself time in the future. Another good habit to get into is to review your trading journal spreadsheet every single day. That way you can get a bird's eye view of your portfolio's trades, and this can give you some insight into your level of exposure as well as if there's room to enter into any more trades. Now, it doesn't matter whether you are a swing trader or a day trader. Becoming a successful trader can be very, very challenging. Now, without carefully planning and documenting your trading performance, you'll be aimlessly moving through the markets, and that's a situation that rarely ends well. By learning how to create and use a trading journal to your advantage, you'll be able to identify patterns, market trends, and other different market factors to help your trading come along much more effectively. Writing down detailed notes to record your ideas, emotions, and trades is an easy investment that can pay very, very high returns.
Gamer token to the moon. It will go back up. The developers have a plan.
Self-destruct sequence activated. 3, 2, 1.
Is this your homework, Larry?
Ask him about the car, man.
Is this yours, Larry? Is this your homework,
Is
Larry?
that your car out front?
Is this your homework, Larry?
We know it's his fucking homework. Where's the fucking money, you little brat?
Before we get going here, if you guys want to go down into the description and download this PDF that I made so you can follow along, it has the example that we're going to run through in today's video. It also has another one in there for you to go back through and practice on your own. So one of the most important aspects of any trading plan is risk management. A crucial component of a comprehensive risk management and trading strategy is knowing how much of your capital to risk in any trade. Now, if you're actively trading, this will be the determining factor of your success, a far more important component in any trading plan than really anything else. And yes, that includes technical analysis. In your risk management plan, you should have designated a portion of your portfolio allocated to trading. For today's lesson, our trading account has a balance of $10,000. Most traders, especially new ones, stick to what's called the 1% rule. The 1% rule says that you will never risk any more than 1% of your entire trading capital on any given trade. For example, if you have $10,000 in your trading account, 1% of your entire trading account would be $100. If you're only ever risking 1%, then you can only ever lose 1%. Now, it's important to practice your strategies, both your trading strategy as well as your risk management strategy. Most exchanges do offer a testnet, so you can check out the user interface and test your strategy on a selected platform. Bybit's testnet is actually amazing. All you have to do is visit the link in the description below, sign up, then ask one of the nice support people in the chat for some testnet funds. All right, so back to position sizing. There's some info that you need to determine before looking at any trading setup. The first thing is you need to know your maximum capital risk. In this case, it's the 1% rule. So we're only risking 1% of our total account. That will be $100 for this example. Another is your acceptable risk to reward ratio. For this lesson, our minimum risk reward ratio that we need to see before entering any trade will be 3. This means that for a trade to meet our standards, the projected target must give us a return of at least 3 to 1, meaning we'll risk $100 to make $300. So say you join the free Telegram group, the link is in the description below, and you catch this Bitcoin setup that I posted on the 4-hour time frame. So what information do we know actually before we even look at the trade setup? We should know our maximum capital risk, which would be $100. And we should know our acceptable risk to reward ratio. That would be 3. Okay, so we busted out our long position tool. Our point of entry is here at $42,407. Our take profit is at $56,100. And we've determined that a safe stop loss would be right here at $38,732, which is about 8.67% from our entry price, giving us a nice risk reward ratio of 3.73. So if you're risking $100 on this trade, you stand to win 3.73 times that $100 should the trade be successful. So using the formula here, risk amount divided by stop loss will equal your position size. Let me say that again. The risk amount divided by your stop loss will give you your position size. So our risk amount is $100 divided by our stop loss, which would be 8.67% or 0.0867, gives us our position size, a position size of $1,153. You might be saying, wait, I thought we were only able to risk 1% of our account. Well, no worries, I got you guys. This is exactly why leverage can be a great tool when used responsibly. However, when used irresponsibly, it can literally wipe your entire account in a single trade. We need an extra $1,053 in margin for this trade. Now, since we're only risking $100, that means we need to borrow $1,053 from the exchange that we're using. $1,153 divided by $100 gives us 11.5. This will be the leverage for the position. But we know that we're risking 1% of our $10,000. That is $100. We're going to divide that by our stop loss, which is 0.0867 or 8.67%. That gives us a total position size of $1,153. So we need to borrow that $1,053 to be able to meet that risk reward ratio that we've predetermined before entering the trade. So we use the 11.5 X leverage. Our stop loss is 8.67% below the price at $38,732. And our take profit order is set at $56,100. A winning trade here will return $367, of course, minus exchange fees. However, a losing trade will result in a loss of $100 plus exchange fees.
Hey, that's pretty good.
Let's go ahead and review that then. Okay, so the trade setup would be to buy the breakout, giving you a 32.29% win on a breakout trade here. And we decided that it would be safe to put our stop loss down at $38,732 because we don't think price action will come back and stop us out there. So that gives us a risk reward ratio of 3.73, which is acceptable according to our risk management plan. So we go through and we calculate our position size. So we know our entry price, that's 42,367. And we know that our stop loss will be 8.67% below that price. So we divide our margin, our $100, our total risk amount, divided by 0.0867 or 8.67%. That gives us our position size of $1,153, $1,053 above our 1% risk. So all we have to do is borrow that difference using 11.5 X leverage from the exchange to meet the requirements that we have set for this trade. Now, leverage is not always necessary here. You can just as easily move your stop loss up and tweak your risk to reward ratio. But it is important to note that a tight stop loss is not always going to give you the most probable outcome for the trade that you're attempting to enter. Now, if a lot of this doesn't make sense to you, or if you still are struggling to learn technical analysis and basic risk management, we have built one of the best trading courses out there, and we are giving it away for free over the next month so you can make sure that you're ready to go when the second half of this bull run starts to pick back up. So make sure you get on over to the website 3candlecollective.com and make sure that you submit your information as soon as possible because spots are filling up pretty quickly. Guys, there's also some pretty awesome resources in here. There's a free fillable PDF TA journal, a free chart pattern journal, a free guide to using Uniswap if you're not sure how to use the decentralized exchange. There's a free portfolio tracker, which does have a position size calculator inside of it, and a simple dollar cost average strategy that did extremely well in the first leg of this bull run, turning effectively $2,200 into $14,000 over 11 months. Also, Pi is one of the coolest free ICOs there is. There's no KYC, and you earn free Pi all day long just for checking in on the app once a day. Pretty cool stuff. But that's it. That's all I got for you guys today. I really hope this lesson helps everyone out. If you have any questions, leave a comment below. I'll make sure to make another video and answer as many of them as I can. Yeah, I hope this video helped. Go ahead and join the free Telegram group. The link is in the description below. And I'll see you guys in the next video. Peace.